Welcome to my Forex trading class. My goal is to introduce you to the world of Forex. I've been trading for a while now, but I remember what it was like starting out. So I created the course to be used as a fast start guide to getting up and active in Forex. You will learn what you need to be aware of before you even make your first deposit of real money into your broker. It's important to have this knowledge before you start putting your hard-earned money into a Forex account. Forex offers a potential to make some extra money, but if you enter a position too large or you fail to safeguard your trades, you place yourself at a high risk. However, you are here and ready to learn, so I hope to overcome these by revealing to you the ins and outs of Forex. I've divided my training into two sections. In the first section, you will learn the theory of Forex trading. I will introduce you to the main concepts and the main platform for trading. You'll learn about the types of Forex trades, how to calculate your position size, and how to safeguard yourself from blowing your account in the first few trades. That will be a very important lesson. And I'll also show you an effective technique for entering Forex positions. In section 2, you'll learn the practical side of Forex trading. The main focus will be on technical analysis of your charts. I'll introduce you to different types of indicators and when they are most effective. I'll share with you strategies that have withstood the test of time and are commonly found in the trader's toolbox for trading. And I will show you the best way to backtest a strategy, so that when you trade live, you can expect better results and not test out tactics using your own money. There's quite a lot to cover. Before we move on, I'd like to mention that the first few lessons may seem difficult. My aim is to introduce you to a lot of concepts early on. The initial exposure to these concepts will be valuable, and in the second part of this course, you will see them applied to real trading situations. Once you see the practical side of things, then a lot of concepts will sink in and start making sense. When I was learning Forex, I tried to study all the theory before making a trade, and this was overwhelming. The most value I got was when I opened my first account and started trading. The practical side enabled me to understand the theory much more clearly, and I believe the same will apply to you. I'm not saying that you have to trade with real money initially. What I'm actually recommending is that you start out using a demo account and using fake money. The experience will be priceless. Thank you for joining my training. I hope that you find the content interesting. Let's get started with the prerequisites you need to know before trading. Welcome to the first lesson. I will cover the main terms that are used in Forex trading. The purpose here is so that you are familiar with them or at least have heard of these terms. Then in the following lessons, you will see how this terminology is used in a live trading environment. So the first term is currency pairs. Pretty obvious. There are three types and they are categorized based on popularity. The 8 most frequently traded currencies are called major currencies, and you can see them listed here. Next, we have the minor currencies, the middle group, and the least popular are the cross currencies. So again, it's a sliding scale based on popularity. So you can trade any of these, and when you set up MetaTrader 4, the trading platform, you will see where to find these currencies. When you see a currency pair, they will be quoted like this. So you can see US dollar and Swiss franc. The base currency is the first currency. It shows how much the base is worth against the second currency, and the second currency is called the quote currency. Next, we have pips. Any currency movement is measured in pips. Pips are on every chart measurement. You will use pips to measure your orders and size of orders. It's like the way to navigate through your charts using pips. Depending on the currency and the broker you are using, you will sometimes see pips, other times you will see mini pips, or known as a pipette. It's 1/10 the size of a pip. Again, you will see this in action later when we jump onto our trading platform. In Forex trading, there is a large potential to make money because you are trading using your broker's money. When you buy a currency pair, you do not own it. This is not like going to an exchange and physically changing your US dollars to euros. When you buy a currency in Forex, there has to be a corresponding sell to complete your order. This is because in Forex you trade using leverage. For example, for every $1 you trade, you could potentially have $100 at your disposal. This would mean that you are using a 1 to 100 leverage on your trades. The positives are that you can earn a lot of money as you are trading with larger sums. The negatives are that you could lose all your money by using your broker's money. However, there is a safeguard to prevent this from happening, and I will share this later. Different brokers offer different leverage for trading. It can be even as high as 5000x leverage, although this is too risky. When you are starting, I suggest you use a leverage of 1 to 20, as it's not too big. You need to learn the mechanics of trading first before taking a risk and trading with larger leverage. To make trading with leverage possible, your broker will require a money deposit known as a margin, and then you can set your leverage. This money deposit is known as your margin, and margin is simply a portion of your funds that your Forex broker set aside from your account balance to keep your trade open and to ensure that you can cover any losses. It's the equivalent to security when getting a loan. Essentially, you are borrowing money from your broker in order to make larger trades. For example, if you have $100 in your account and you are trading with $1,000, so 1 to 10 leverage, the broker takes a certain amount from $100 as the margin for that trade. When the trade is completed, you get back your margin. If you are trading with $1,000 but your account only has $100 in it, if the trade goes against you, your entire account can be wiped out. So how do you safeguard yourself from having your account liquidated if your trade goes bad? The answer is by using a stop loss order. This is an open order that is a number of pips away from your entry price. If this stop loss is reached, your position will be exited and you will only lose a predetermined amount. So what is this predetermined amount? It's your risk ratio. When it comes to Forex trading, each position you enter represents a risk to your account balance. So if it goes against you, you lose a certain percentage of your account. For example, if your account is $100 and you are risking 5%, then your stop loss will be placed at a level that if it is hit, you lose $5. A generally acceptable process is to use a risk ratio of between 1 to 2% of your account. Now the reality is, when you're trading, you sometimes hit consecutive losses. And if you're trading at a 10% risk ratio and you hit 5 losses in a row, then you are down 50% of your account. If, however, you're using a risk ratio of 2% and you have 5 consecutive losses, then you are down only 10%. So this is a safeguard and stop losses should not be treated lightly. Now let's talk about lots. Welcome back. I have an important step for you to take. I think this is necessary so that you can follow along with my next lessons and get familiar with the process of trading Forex. And that is to open a demo account with a broker. There are many brokers available. Depending on your region, you may have to find a local broker. In this lesson, I am not recommending any broker because this is all about setting up a demo account so that you can trade. Once you sign up for a broker, you will download their trading platform. And one of the major trading platforms is MetaTrader 4. This is like your control module for executing trades and managing your account. The platform that I use for demo purposes is Oanda. Let me show you how it works. Here's the Oanda website, and this broker is actually quite a good broker. So if you consider to use it for live trading, it's an option. But I find that their demo account is really great and it's very easy to set up. So what you would do is you would just go to their website, click on menu, go to CFD trading, and then you can click on try demo or start trading, and you can open up a demo account. So you'll have to register an account with them, and when your account is open, then what you can do, or actually you can even go there right now, just go to platforms and then MetaTrader 4. They have a number of other platforms here. Personally, I don't really I never trade on a phone. The screen's too small. They have a desktop app and a web app, which it's okay for trading, but the thing is, it doesn't have all of the features that I'm after. So MetaTrader 4, I'd say this is the tool that you need. It's like a control unit. Everything that you need for trading, for setting up charts, it's here. So what you would do is click on MetaTrader 4. And then here again, you can either click here to create a demo account, fill in all your details, register, download the MetaTrader platform. And then when it's downloaded, then you'll have to just open the platform, log in, and you'll get something that looks like this. This is MetaTrader 4, and pretty much all of my lesson I'm going to be using MetaTrader 4 for explaining you how Forex works, explaining you how to set up orders, showing you the different types of indicators that you can use. So I would say that MetaTrader 4 is the best place to start Forex trading. As a demo account, of course, but it's the best way to learn all the ins and outs of Forex trading. Later on, you can have a look at the other platforms, but I have a feeling that once you learn MetaTrader 4, you'll stick to it. And this concludes this lesson, so I highly recommend that you go out and create your own demo account at this moment. In this lesson, I want to introduce you to the types of Forex orders. There are 3 orders you can take to enter a position. The first is a market order. When you either buy or sell using a market order, it means you are buying and selling at market price. The order will happen instantly at whatever the market price is. This order can be relevant to your trading strategy, but there are 2 more order types that you should be aware of. First, let's cover the buy-sell stop order. I find the easiest way to remember this order is with an analogy. So let's say you are waiting for a bus and you are at the bus stop. The bus drives and stops, picks you up and drives on. And it drives on in the direction it was initially going. In Forex, a buy-stop order is like being picked up at a bus stop. So let's convert this analogy to price. For a buy-stop order, the price starts lower than your ideal entry price, but you anticipate that it will increase. So you place your order above the current price. If the price rises, then your buy order will be executed, and then hopefully the price will continue to rise. A sell stop order follows the same principle, except you want to enter a short position. So you want to sell and you want to enter it below the current market price. Whether it's a buy stop or a sell stop order, these are pending orders. So they only get executed once the price reaches your level. Next, we have something known as a buy limit order and a sell limit order. In a buy limit order, you anticipate that the price will go up, but first it will make a pullback. Or you look at the chart patterns and currently the price is too high for you to enter. So what you do is you want the price to come down, and if it reaches your level, then it will trigger a trade and then you will enter. So when you create a limit order, you expect the price to bounce. So it will go down, hit your order, and then bounce and continue going up. The same applies to sell limit orders, but the opposite applies. So the price is going down. You think it's going to go down even further, but you expect it to make a pullback, in this case go up, before it takes another drop. So you place a sell limit order above the current market price. If the price goes up a little, it will execute your order, you will enter it, and then hopefully you expect the price to go down. And that's all for the 3 order types. I hope my analogy has made this much simpler for you to understand. Do not worry, when we go to MetaTrader 4, you will see exactly how the buy stop, buy limit orders, how market orders, how everything is applied in action. In this lesson, I want to show you how the different order types look in a real trading environment. And by real trading environment, I mean a simulated trading environment. So as you can see here, we have a chart. It's the Australian dollar, Japanese yen, and I can click play, see how the chart performs, and then pause it anytime I want. Or if I want, I can just skip it ahead 1 bar at a time. So here we have a chart. This pink line here, it's a slow moving average. I believe it's a 200 period moving average, and this is a technical indicator. I'll introduce you to these indicators in future sessions. And the red line, it's a 15 period moving average. For now, this is not important. What I want to show you is the order types. So we have a chart pattern that seems to be going down, and it may actually bounce from this moving average. So what I want to do is I want to buy it at this moment, buy it at market value. So I would just click on buy. And what happens, this green line, it represents my buy order. So instantly I will enter this position and I will hold this currency. So let's play and see where the price goes. So after the initial drop, the price actually went in the good direction. So what I'm going to do is I'm going to terminate this position with a small profit. Okay, I have just closed it, and as you can see, we bought it here, closed it here. In a live trading environment, you will not see this. This is part of the plugin that I'm using so that I can play around with past data and see and test different strategies. So this was a market order. Now let's just play it a little bit. Okay, we can see that the price has started to go down. So I want to place a sell order at market price. And again, we see this line here. So it represents my sell order. Let's see what happens to the price. Okay, it went completely against me. So let me just close it. And that was a sell order. Here we see that it didn't go in our way, so we would have lost money. Let me just actually skip it ahead a little bit to see something a little bit different. Okay, we have a chart pattern here and it seems to be trading up. So now I'm going to do a buy limit order. So what I mean by buy limit is I expect the price to go up and I want to buy, but I don't want to buy at this level. I want to buy at a lower level, something here, for example. And this level, it's actually 17 pips away from the current market price. So I will click on here on pending order and I will select the number of pips away from the current market price at 17 and I will click on buy limit. So as you can see here, it has created a pending order below the current market price. So this is a buy limit order. Now let's see if this works at all. Okay, it has entered below. And if we look at trades, we have currently one open position. And here's the profit and loss of this trade. This is a simulation, but it would be nice if it went up a little bit. Perfect. Okay, I'll pause it right there. We see this current profit here. This was a great example of a buy limit order. Price was here, we wanted to enter it here, we set up the order here. When the price fell, it triggered this pending order, entered our position, and then the price went up. So let's close this position at a profit. So this was a buy limit order. Now I'm going to show you a sell limit order. So for example, a sell limit order occurs when obviously we want to sell, but we want to sell at a better price. So current price is here, but we want to sell it at, let's say, this level. So let's say we want to enter a sell order at 14 pips away. So I'll set up the distance at 14 pips and I'll create a sell limit order. So it's a pending order. If the price touches this point, it will sell. Let's see what happens. Okay, this time didn't work, the price just fell down. However, I still want to use this example and show you what a sell limit order looks like. So I'm going to modify the current order and in this lesson, I want to go over the easiest way for you to calculate your position size. The reason you need to know what size you are buying is because you are using leverage and buying orders with borrowed money. If you enter a position size too big and the trade goes against you, you are at a risk of blowing your account. Before entering any trade, you need to know the trade size or lot size or position size, let's call it. All of these refer to the same thing. And to calculate the lot size, you need to know the following: the currency pair you are trading, your account size, the risk ratio, so how much of your account are you willing to risk, the stop loss level, so at what price will you exit the trade. This will be your stop loss, and you can calculate this by how many pips away it is from your entry price. And you need to know your trade size, so how much lots are you actually buying. Do not worry, as I am not diving into a mathematical calculation for this. There is an easier method. Just go to this website and fill in the blanks, quite literally. I'll show you that right now. Here we are on the website, and it's literally the easiest way that I know of how you can calculate your position. So you start off by selecting the relevant currency pair, then specify your main account currency. and the account size. So let's say we have one account and $1,000 in that account, and we want to risk $10, which is the risk ratio of 1% of our account. Then specify the stop loss level, or how many pips away your stop loss level will be. You will calculate the number of pips by reviewing your charts. So you will use MetaTrader 4 for this. For the trade size, let's leave it at 1 in lots. You can change it to units if you want, depending on your broker, and then click on calculate. So here we see that we are risking $10. Here's how many units we are buying, and here's the size of the order, 0.07 lots. So this is the figure that you will plug into MetaTrader 4 to complete your order. Why make life difficult when calculating a position size is really so easy as just filling in the blanks? Let's continue to the next lesson. In the previous lesson, you learned how to calculate position sizes for your trades. Now I want to show you what you need to decide before entering the trade. It is not enough just to open an entry position. Each trade you take requires at least another trade. Can you think of what I am referring to? As you are using leverage for your trades and you need to put up some of your account balance as margin to open a position, you need to protect your balance. So you do this with a stop loss order. Thereby, you protect your account balance with a maximum you will lose if the trade goes against you. So you have an entry position and a stop loss order. As you're starting out, I suggest you take a step further and set an additional take profit order. Price fluctuations are unpredictable, and a simple news announcement can make the price go crazy. That's why it's important to secure yourself and plan out what a profitable and losing trade actually looks like. So I cannot stress this enough, but you should always use the stop loss because there is too great a risk of blowing your account. Leverage trading is nice, but it is risky. Stop loss is the safeguard. Many advise that you should never risk more than 2% of your account size. When deciding the take profit and stop loss levels, you should calculate how many pips apart this will be. Here's how this looks in practice. Here I am in MetaTrader 4, and currently I have the British pound US dollar charts pulled up, and I am using the 15-minute charts. So I can see that the price is making higher highs, higher lows. It looks to be going upwards. So let's say I want to enter a market order and I want to buy right now. The current price is here. The stop loss, I want to set it below the previous low. So I will set it at this level. Actually, to make it a little bit easier, here's my stop loss level. And the take profit, I'm also going to set this up. So I'll set it around about here. So from the current price, I have a stop loss at 48 pips away, and my take profit will be 70 pips away. So I go here, I click on new order, and I make sure that the symbol selected is the British pound US dollar. Here I specify the lot size, so I'll make it a small order, 0.01 volume. So the stop loss will be, let me just fill it in, 1.20060. Take profit will be 1.21239. And to show this to you, I'll delete these lines. Everything is set up, so I am going to buy. Okay, I've entered the trade. This green line here shows the current price that I entered. As you can see here, you can see it's buy and the size of the order. This order here, it's my stop loss order. It's a pending order, and when I hover my mouse over it, I will see that the potential profit at this the loss I will make at this level will be $7.41. And it even shows me that it's 50 pips away. This MetaTrader on Oanda, it's showing me the micro pips. So I just divide it by 10 and I get pips. So 506 micro pips or 50 pips away. Now this order here at the top, it's my take profit order. And again, it is a pending order that will be hit if the price reaches this level. So it shows me again that the potential profit will be $9.85 and it's 67 pips away. And if we go over here to the bottom, we can see the current order that I have placed. And currently I'm at minus 44 cents. However, we already see here, this is my stop loss, which has already been set up, and the take profit, which has also been set up. In a live trading environment, what you can do is you can move these trades. Let's say I want to change the stop loss to below here. I've changed it, so this will be the new stop loss level. So here I will only lose $3.42. Similarly, if I want to adjust the take profit order, I can just move it, and now this has been set up differently. Alternatively, if I want to exit it, I just click on the cross, and now the order has been exited. So I sold it at a loss. Welcome to the next lesson, and actually welcome to MetaTrader 4, which what I have already called the control module for all of your Forex operations. I think this is the best tool because it's the easiest tool, although it looks a little bit difficult, especially the first time you log in. Once you log in a couple of times and use the platform, it's actually very, very simple. I have already configured my charts. I like the white background charts with green and red candles. Other people like something different, but actually this is what you are going to see when you open it up. This is the custom default. This is the default settings. And personally, I do not like this. So what I do is I go to properties and I format the chart. And I've already created a template that I like to use. Triple EMA, but let me just remove these indicators so that you can see the basic chart that I like to play with. I think this is the traditional white background, green and red candles. Now, when it comes to Forex, what you need to do is you need to decide what time frame do you want to trade at. So if you want the long-term game, you can use 4-hour charts, perhaps daily charts. The advantages of trading, or even 1-hourly charts, and the advantages of trading these time frames are that the charts, they're actually a lot cleaner. It's much easier to notice certain patterns, and even the indicators that I will show you how to use, the indicators, they are more accurate on a longer time frame. But a lot of people, they have more time, so they can actually go and try the 15-minute charts. This chart, the Euro New Zealand dollars, 15 minutes actually looks quite nice because there are patterns forming, there are trends forming, and this looks very, very tradable. But sometimes, depending on the time of the year, depending on the currency, 15-minute charts, 5-minute charts, they just look like a big mess. So 1 hour and 4 hour are better. But it all depends on your trading style. So you would have to decide how many hours you want to spend in front of a computer, how many signals you want to see per day, and then decide on the ideal time frame for your trading style. Let me go over a couple of principles that I covered in the first section of this course. Firstly, I will go to symbols, and here's what I want to show you. Depending on your broker, you will see different types of settings. Sometimes you will see major currencies, minor currencies, and cross currencies. However, I'm using the Oanda demo account, and it's pretty much, I have a full list of currencies under these categories. But basically it works like this. They are mixed up here, but basically major currencies are the most popular currencies that are trading against the US dollars. Minor currencies are less popular currencies that some trade with US dollars, some trade between each other. And then cross currencies, they are the currencies that are like not popular, like for example, Czech koruna trading with the Polish zloty. That would be a cross currency. But what you have to do is a lot of these currencies, they're grayed out. So you will have to double click on them, select the ones that you want to trade, and then we can close this, and then they will appear here. And then what you do is you open a chart window. You will get the black themed chart settings. Then you can create a template, load the template that works best for you. Here's another template that I've created. Next, what I will show you is over here, this is a demo account, and you can see the balance of my trading account and the free margin. Now, when I want to open a new trade, I click on new trade, and let's say I want to buy at this level. Here's the volume, 0.01, and I'm trading the Australian dollar, Japanese yen. I will not set a stop loss here or a take profit. I'm just going to create a buy order. I click on it, and this green line represents my entry level. And here you can see that the balance is $1,733. Free margin has lowered because margin of $50 is used for this particular trade. So this is the margin. This is the money that I put up from my very own balance so that my broker can make the trade. And I believe the leverage that I'm using in this. Welcome back. In this lesson, I want to talk about trend lines. And trend lines are lines that show you zones at which there's a huge chance that the price will reverse. So it's very relevant to, well, swing trading, and it's also relevant to figuring out the trend. Hence the name trend lines. I will show you how to analyze a chart, and you may be surprised by the results. Now, this is a normal chart of the British pound US dollar, and it's 15 minutes. Of course, trend lines do apply to 15-minute charts. However, because of the fluctuations in price, I think it's better to analyze trend lines over a higher time zone. In this case, for an example, I will use the 4-hour charts. So this is how we figure out trend lines. Basically, we draw the trend line, click the button, and let's connect a couple of bottoms. And we can also connect the tops. Let's make it fit a little bit better. And actually, I think this is actually a random chart that I just popped up when I loaded Oanda. And I think it's a really good example of trend lines. Here's the thing, especially the top trend line. What we see here is that the price bounced from the bottom to the top of the trend line, then bounced to the bottom, to the top, to the bottom. And then what happened here, actually I can draw another trend line like this. And as you can see, the price goes up, bounces to the bottom, bounces to the top, bounces to the bottom. And basically the way that you trade with trend lines, well, there are a lot of different variations, but the theory goes like this. Once the price reaches this top, there's a high chance of a reversal happening, so you can place a short order to sell. And then when the price reaches the bottom, there's a chance that again, it will reverse, so it's time to buy. So that is the first version of trading with trend lines. The other theory is that if a trend line is broken, then the chances are the trend has been broken and it's a time to change. So in this case, the trend line got broken, and instead of going up again, it started slowly going down. Then we have this trend line, which I would say it is a trend line because we've got 1, 2, 3, 4 bounces. Here you could say there was a fake out attempt. Okay, and we are to the current time period. But let's move back in time, and maybe I can show you another example of trend lines. Actually, there are plenty of examples right over here. So I'll select the trend line, I can draw one here and here. Now, what happens with trend lines is that sometimes they're parallel in the same direction. Other times, they can be opening, like they can be expanding trend lines, or in this case, slightly decreasing trend lines. But the theory is that if you figure out that, okay, you figure out there's a point here, a point here, point here, point here, draw your trend line, then you can predict where the price is going to bounce. So here, if you draw it like this, you've got the bounce here, and a couple more bounces before it breaks. And when the trend line actually broke, it started going up, and you will find it hard to believe, but we can draw another channel. So another 2 trend lines here. So it jumped from, we have 2 highs here, 2 bottoms here. We draw the trend lines, and as you can see, the price moved Maybe it didn't go, exactly 1, 2, 1, 2, bouncing from top to bottom, but it did trade within this channel. And this is another great example here. When the price broke through the trend line, it came back to the trend line, and this trend line, so here the trend line was a support zone, and the price always bounced away when it hit the trend line. But once it broke through the trend line, then the trend line became a resistance zone. So it hit here and then it came back down. And I'm willing to bet that we could draw some sort of new trend lines here. And then as you can see, price is trading within these trend lines. Okay, I think I'll zoom out a little bit. Okay, this is 4-hour charts, but as you can see, the price was, it was like a pattern, and it was going down, up, and most. Welcome to another lesson of technical analysis of your Forex charts. In this lesson, I want to focus on support and resistance zones. And by the end of this lesson, hopefully I'm going to show you something which you may think is quite odd and actually quite predictable when it comes to price charts. Support and resistance works on all of the time frames. However, I find that because of the fluctuations that happen in price, it's better to take a higher time frame, like 1 hour or 4 hour. And I think this will be the best way for me to show you support and resistance zones. I'll just format this line. So the yellow line looks good. And actually, I placed it here tactically for a good reason, because I think this is a good support/resistance zone. And the second one I will place right about here. Well, let's start with resistance. Price was going up, it hit this zone over here and then rebound. Tried to hit this zone again, rebounded. Here again and here again. So we have 4 touches of this zone and it never broke through this zone. Because we have these clusters of price action at these levels, they are our resistance zone. The price does not want to break through and go further up. Now let's examine the support zones. From here, the price fell, bounced off this level, and fell over here, bounced off this level again. And we could argue that there was a bounce here as well. So there's 3 touches here. It didn't want to go further down. Therefore, this is a support zone. And I've drawn the top level resistance, bottom level support. And as you can see, the price is nicely trading within this channel. So you can use this to figure out when to enter. So you enter during when the price is at the bottom, or when to sell. You sell when the price is at the top. Another thing that I will show you here, this one over here, the price clustered through, didn't break through. This was a resistance zone. Price came back down, came back up, broke through, and when the price breaks through a key resistance zone, then the resistance becomes a support zone. And then, as you can see here, it was a resistance zone over here, and then it became a support zone after the price broke through. Let's move back a little, and maybe I can find you another example of support and resistance. And I think I have just spotted something. Actually, I think this looks quite well. What I could even do, move this like this. And I think I have good examples here. The price was going down and it bounced off this zone, came back down, and then finally it broke through the support. When it broke through the support, it found another support level, which was over here. And then when it went back up, the previous support was a resistance. And when we look at the price chart, it actually is, this example is really good, because you can see that the price, it's trading within these channels, so within these support and resistance channels, and you can actually predict where there is a high chance of the price actually bouncing through. Well, here the price went down a little bit further. It was like a fake out. So you would have thought that maybe it would go down further, but no, it picked itself up and then started trading within the channels again. But then when it broke through the resistance, then the resistance became the support and the price started trading up. And the thing is, you can spot support and resistance zones on pretty much any chart, any currency pair whatsoever. The only thing that I would suggest is that you use the higher time frame because it will be a little bit more accurate. But let's go. Okay, so this was the 1 hour. Let me just clear my chart and I will change to a daily chart. So examining this, I think we have a zone here, because you can see there are plenty of touches here. So this is a resistance area, another touch here, and I think there is one here. Let's move this down a little bit, and I think there's probably one here as well. But as you can see, there was a touch here, a touch here, a touch here. Hello again, Tom here. In this lesson, I want to go through a couple of the indicators that you can use to develop your own trading strategy. I click on this button here. Now I can add all sorts of different indicators. I've selected trend, and I think I will start with moving average. So I will set up a 50 period exponential moving average. This just means the way the moving average is actually computed. So there are a couple of ways. I always use either simple or exponential, but you can play around and try different moving average parameters. And I can add it. So this is the first indicator, and this is a trend indicator. And by trend indicator, it's supposed to show you when the price is going to trend up and when the price is going to trend down. So how does it show you this? Well, this is like, you could say it's a baseline. And when the price breaks through this moving average, there is a chance that it's going to continue upwards. So here we saw it break through and fail, but then here it broke through this indicator and then was trending up for how many? 208 pips. Remember from the previous lesson, I have 2087 here because that's showing me mini pips. So I divided by 10 and I have the pips. So 208 pips. Then we have the price. It broke through the moving average, tested it out as a resistance area, didn't break through it completely again because it quickly fell back down, and then it started trending downwards for another 207 pips. So if we entered it here, it would have been a really, really profitable trade. And then here's another example where the moving average got broken and the price went up for a further 208 pips. So this is a moving average, and it's actually really effective when the market is trending. Let's go back in time. I can show you another example. Okay, I think I have found something which will be quite interesting. Something that will be quite interesting over here. Okay, that's a really, really ugly color. I'll just make it something that's just more friendly to the eye. Okay, a little bit too friendly. Okay, that's better. Ignoring this, we see here the price was above the moving average and it was trending up. So this was a trending market and everything was okay here. However, here the price was sort of in a consolidation. It was just moving up and down, up and down. And as you can see, the moving average, it didn't predict anything. It was just being broken all the time. This is the weakness of the moving average indicator. If it is a consolidation market, well, the moving average will give you a lot of fake symbols. So the trick is you have to figure out when it's going to be a trending market, and that's when you enter it. So any type of trends. So over here we have another consolidation. And by consolidation, I mean prices just going nowhere. It's just moving up and down, up and down. And for this, moving average is useless. But if we go to 4-hour charts, and you can see whenever there is a trend in place, moving average gives you good signals. So this is, I think I'll remove this. So this is the moving average. It's a trend indicator. We have other trend indicators. Another one is known as, I think, Bollinger Bands. And this is based on the moving average. It will give you 3 lines. I'll format it so that it looks a little bit better. And the basis of the Bollinger Bands is we have the moving average and we have the average directional movement that determines the upper band and the lower band. And the price, it supposedly bounces within these bands. So the theory is if the price goes to the bottom of a band, it's a chance to enter because the price is going to go up. If the price goes to the top of the band, it's a chance to sell because the price is going to take a turn. So it's another type of trend indicator. Sometimes it can be useful. Personally, I don't like this indicator. It gives a lot of fake symbols. However, it could be a good indicator that you can use to place your stop loss zones. And I'll show you another trend indicator, but for a different chart. Okay. Welcome back. And in this lesson, I want to talk about the next type of indicators, and these are the oscillators. So you have a whole list of different oscillators here, and basically let's do the relative strength index first. Actually, I will just adjust it so it's a little bit more presentable. Yeah, that's pretty visible. So the way it works is you have 2 zones. At the 30 level, you have an oversold level. And this can be 30, can be 25, can be 20, however you decide to customize it. But it's an oversold level. So basically, the way it works is that once the price goes below this, then expect a reversal that the price is going to go back up because it's oversold. So it's a time to buy. So if we bought here, we would have been profitable. Let's see, the next breakthrough happened here. So if we bought around this level, wouldn't have been great, but the price sort of bounced up. Now we have the 70 level, which is the oversold level. So it can be 70, 75, 80, depending on the price chart and depending how you customize it. So basically, when the price goes above or touches this line or crosses this line, it's in overbought territory, and it means it's time to sell. So here it was the RSI was touching the line, so it was a time to sell. So if we did sell here, we would have been profitable. Next time it touched the line here and here. Well, if we entered around about this level, the price did fall down. The thing with oscillators is that they work really great in a consolidation market. So if you have the price which is moving from between 2 particular zones, it's not trending anywhere, it's in a consolidation, then these oscillators, they actually work quite fine. When the market is not trending, then trend indicators do not work, but oscillators do work. However, when the market starts trending, well then trend indicators work, but the oscillators, they fall apart completely. Probably there wasn't enough movement here for trading. So when the RSI line is just between the lines, just forget about trading because the price is going nowhere. And then the price started trending. And here's actually a good example where this indicator falls apart, in that here we had a touch of the indicator. So a brief crossover, it could have been a chance to buy, but the thing is, market was trending downwards, so it would have been a loss. Actually, let me rewind this. Okay, here's a good example. The indicator crossed below the 30 level line here, giving us an entry point, say around about here or here. Now, if we did enter, we would have made a lot of many pips profit, and it would have been a good trade. Then the market started trending downwards, and we got a signal here to enter. It was a fake signal, we would have lost. But then the second signal to enter we got here, and if we entered it, again, we would have been quite profitable. So this is the RSI. Let me show you another oscillator. The stochastic oscillator. Actually, not my favorite oscillator. and I don't use it, but I think you should be aware of it. I'll just adjust this to make it a little bit more user-friendly. So in this indicator, you have an overbought zone and an oversold zone. So basically, when the line crosses below, it means it's overbought. And then when there's a crossover between the two lines, here it's a chance to, in this particular case, to buy. So if you bought here, would not have been a brilliant trade, especially since it immediately had a pullback. And then when the line goes above the 80 level and there's a crossover, it means it's a chance to sell. But as you can see, here would have been a bad chance to sell. Here would have been, well, not brilliant as well, depends on your stop loss. Here actually would have been an excellent opportunity to sell because you would have made a lot of profit. But the thing that you can do with this particular indicator is you can play around with the parameters. So I will just set it up a little bit longer time periods. And now the indicator looks a little bit